The $20,000 gold bet and the silver move that changes everything. Someone just bet $11,000 that gold will reach $20,000 by December. $20,000 last month. Gold hit an all-time high of almost $5,600. After that, it fell all the way to $4,400. It's about $5,000 right now. And someone saw all that crazy price movement and said, I'm not interested in buying at $5,000. Even at $10,000, I'm not interested. I want the right to make between $15,000 and $20,000, and they put a lot of real money on the line for that belief. There are 11,000 contracts on COMEX, all with deep out-of-the-money call spreads that end in December. This is the kind of trade that only makes sense if you know something that the rest of the market doesn't. But this is what really caught my eye. Wall Street is betting on gold to go up to $20,000, but the U.S. government just did something with silver that changes everything. This is something that has never happened before in the modern history of this country. If you connect the gold bet and the silver move, you'll know exactly what's going to happen. Stay with me because this will change the way you think about both metals forever. First, let me explain the gold trade in detail, because every little thing matters. On Monday, gold futures closed at $4,990, a little down. Conditions for trading during the holidays: a dollar that is stronger. Nothing that looks strange at first glance. There is something amazing happening in the options market, even though it looks calm on the outside. Traders have been steadily adding to their positions in call spreads for December 2026 with a range of $15,000 to $20,000. With a call spread, you buy the right to make money if gold goes over $15,000. This structure cuts the cost up front, but it also limits how much you can make. You pay less to get in. It's a bet with a clear risk and reward. And this position has grown to about 11,000 contracts. Akash Doshi from State Street called these trades cheap lottery tickets. Take a moment to think about that phrase. Lottery tickets that don't cost much. When one of the biggest institutional asset managers in the world talks about a trade like that, it means two things. First, the trade is far away from the prices right now. Two, the people who make it aren't stupid. They know exactly what the chances are. And they're doing it anyway because the possible reward is worth every dollar they spend. Gold would have to triple in value by December for this trade to be worth it. From about $5,000 to $15,000. That sounds totally over the top. And to be honest, if you had told me that a year ago, I would have laughed. But I would have also said a year ago that gold at $5,000 was unlikely, and here we are. Gold has already reached $5,600. It has already shown that it can move. $1,000 in just a few weeks. There was never any doubt that gold could make big moves. It just showed us that it can. The real question is how big the next move will be. I need to put this $20,000 trade in the right context now, because context is everything here. Then, on January 30th, Trump picked Kevin Warsh to be the next head of the Federal Reserve, and the market went crazy. Gold fell 16% during the day, from $5,600 to $4,400. It was the biggest one-day move we had seen since February 1983. Nothing like it has happened in more than 40 years. Silver got hit even harder. In just a few hours, it went from $121 to $64, a 39% drop. Silver futures fell by 31.4%. The worst day since March 1980, that's a long time, 46 years, worth billions. Gone in one trading session. It was easy to see why the crash happened. Warsh is known for being a monetary hawk. He worked at the Fed from 2006 to 2011 and spoke out against quantitative easing in public. For the past year, the markets had been pricing in a dovish Fed chair who would let inflation run high and keep the dollar weak. The debasement trade was the whole reason for the gold trade for a whole year. Warsh's nomination put an end to that story right away. Managed money net longs on COMEX gold dropped by 17,741 lots in just 1 week. Speculators cut their bullish positions faster than they have in a long time. Silver ETF holdings fell for 7 days in a row, reaching their lowest level since November 2025. The sell-off wasn't just strong, it was built in. Positions that had taken months to build were wiped out in a matter of hours. And this is where the story really starts to get interesting. After all, the worst crash in decades, the forced liquidation, the margin calls, and the full-blown panic, someone walked into the options market and started building an 11,000 contract position. Retail doesn't put 11,000 contracts in deep out-of-the-money call spreads. That's money from institutions. That person has a clear, well-researched thesis. The point is that gold will go up 300% from here by December. Now let me tell you why I think this trade isn't as crazy as it sounds. And I want to be clear, I'm not saying that gold will reach $20,000. What I'm saying is that the logic behind this bet makes sense. Not at all. This is why. And the things that made that doubling happen are still around. In 2025, central banks bought more than 1,000 tons. 22 different central banks added to their gold reserves. Poland bought 102 tons just for the sake of national security. Also, more than half of the gold that central banks bought last year was not reported, buying things in secret. Governments are hoarding gold and not telling anyone. The picture of corruption is getting worse. The United States just got its lowest score ever on the Transparency International Corruption Perceptions Index, 64 out of 100, equal to the Bahamas. The Foreign Corrupt Practices Act was put on hold. That same year, 6 big Western countries got the lowest scores ever. Trust in institutions around the world is dropping fast. The U.S. debt is $38.43 trillion and grows by $8 billion every day. Interest payments are about to hit $1 trillion a year. The Congressional Budget Office says that interest is now the fastest growing federal expense, ahead of Social Security, Medicare, and defense. This is the part that has to do with the $20,000 bet. Kevin Warsh just confirmed over the weekend that the Federal Reserve is going to work with the U.S. The Treasury will be in charge of yield curve control. Let that land, control of the yield curve. This means that the Federal Reserve will set a fake limit on interest rates on government bonds so that the government can keep borrowing costs low. The last time the U.S. controlled the yield curve was during and right after World War II. It is like saying in public that the debt is impossible to pay back at normal market interest rates. The Trump administration is basically trying to get out of $40 trillion in debt by making the economy bigger. Elon Musk tried to cut costs with Doge at the start of the year. That didn't work. You can't cut enough to make a difference in $40 trillion in debt, so they're going in a completely different direction. Blow up, print, lower rates, and hope that the nominal economy grows quickly enough to lower the debt as a percentage of GDP. If that's the plan and the evidence strongly suggests it is, then gold isn't going down in the long run, it's going up. Very high. Yield curve control is the best possible situation for gold to rise in value. You're telling everyone in the market that real interest rates will stay low for a long time. That inflation will always be higher than the interest rate on government bonds, and that no one can do anything about it because the central bank will buy whatever bonds it needs to keep yields down. In a world where the yield curve is controlled, the $20,000 call spread makes perfect sense. It makes sense in a world where the Fed is purposely lowering the value of the dollar to deal with too much debt. In a world where $40 trillion turns into $50 trillion, then $60 trillion, and no one even pretends to have a plan to pay it back. This makes sense. Seth Carpenter, Morgan Stanley's chief economist, wrote a note saying that things won't change much under Chairman Warsh, at least not in the near future. The Fed is a group. One person can't change an organization overnight. Even Warsh, who is known for being a hawk, is going into a situation where the debt is so huge and the interest payments are so high that the only option left is financial repression. Put more air in, put down, print, that's the way to go. I think that's someone who really gets the endgame. They aren't betting on gold, they are betting against the dollar, against the spiral of debt, against the system's ability to deal with what is coming without systematically lowering the value of the currency. And in the past, that bet has always been right. Every fiat currency that has had this much debt compared to its economic output has eventually lost value. All of them, without a doubt. And check out what's going on with implied volatility right now. The $20,000 calls have made implied volatility go up for all the gold options, especially for far upside strikes. That means the market is now taking into account the chance of very big swings, not just 5 or 10% swings, but the kind of parabolic moves that make gold stop trading on fundamentals, where it only trades on fear, on money leaving the country, and on a complete lack of faith in the financial system itself. After the brutal crash from $5,600 to $4,400 in January, and the sharp correction to $4,000 in October, realized volatility is still high. This market is still very volatile. It's curling up like a spring, and that's exactly what the options market is showing. I also want to say something about the structure of this trade that most people don't notice at all. A call spread is a lot cheaper than a naked call option. That means these 11,000 contracts are for a position that has been carefully chosen to save money. These traders aren't just throwing money around. They're making a position that gives them more upside than downside. They lose their premium if gold doesn't reach $15,000 by December. That's it. But if gold goes above $15,000, every dollar over that up to $20,000 is pure profit, multiplied by 11,000 contracts. The numbers on the upside are truly mind-blowing. And the people who are making this trade aren't doing it in a vacuum. They are building it while gold stays around $5,000. Central banks keep buying a lot. Yield curve control is being openly confirmed, and the U.S. debt clock goes up $8 billion every day. The time is not random. The way things are set up is on purpose. Now I'll tell you what's going on with silver. Because the silver situation is much more dangerous and volatile than the gold trade, which is like a lottery ticket. Everyone was focused on the gold crash, but something happened with silver that no major news outlets reported on. And you'll see why silver might be the most uneven trade in any market in the world. Right now, once you understand what I am about to show you. The Geological Survey finished its list of important minerals for 2025. The list now has 10 more minerals on it. And for the first time in the whole modern history of the United States, silver was on the list. Silver is now officially classified as a critical mineral. That is important for the economy and national security of the United States. It is now in the same group as lithium, cobalt, uranium, and rare earth elements. This is not a sign. This is structural and will last forever. The legal designation of critical minerals requires the government to focus on protecting domestic supply chains. It speeds up the process of getting permits, gives direct subsidies, tax breaks for production, and most importantly, it sets up strategic stockpiling. The National Defense Stockpile is run by the Defense Logistics Agency. Congress just gave $2 billion to make it bigger. Last year, the Department of Defense said it wanted to buy up to $1 billion worth of stockpile materials. And now silver is on the list. The question isn't if the government will start buying. The only thing that matters is how much and how quickly. The policy framework is all set up. The money has already been set aside. The laws are already in place. The only thing left to do is carry it out. And this is the part that should scare anyone who is short silver. China has control over 70% of the world's refined silver supply. 70%. China officially added silver to its rare earth minerals export control rules on January 1, 2026. They're purposely cutting off the supply, on purpose. So the U.S. is calling silver a critical mineral and is working hard to stockpile it. At the same time, China is calling silver a strategic resource and limiting exports. Two great powers. Same metal. Different sides of the trade. Both are trying to get as much physical silver as they can. I follow one analyst who calls this World War Silver, and that's exactly what it is. A strategic fight for control of a metal that is necessary for all of the major technologies that will shape the 21st century. Solar panels, electric cars, semiconductors, military systems, medical equipment, 5G infrastructure, and cleaning water. All of it has silver in it, and both governments know it all. Now, let me show you what's really going on. Because the raw data is even scarier than the headlines about the policy. The Shanghai Futures Exchange now only has 11 million ounces of silver in stock. 11 million, that is very bare. there isn't much metal left in the warehouse. The amount of silver registered on COMEX just dropped below 100 million ounces. This is the lowest level of inventory in years. The market for goods is very tight, and it's getting tighter every day. Recently, silver lease rates went up to more than 6%. They've dropped to about 3% now, but that's still not normal. A 3% one-month lease rate shows that the physical market is really, really tight. People are paying a lot more than usual to borrow the metal for a short time. That just doesn't happen when there is enough supply. When supply is really stressed, that happens. And this is what really got to me. In the weeks before the January crash, something that had never happened before happened in the whole silver industry. The cost of hedging for refiners, dealers, and wholesalers became too high to handle as the price of silver went from $20 to $121. Think about what happens when you are a silver refiner and need to protect your stock. You sell COMEX short to make up for your physical position. That's something that happens all the time. But when the price of silver goes up by 100% and then 300%, the exchange keeps raising margin requirements, your hedging costs go through the roof, your credit lines are full, and all of a sudden you can't run your business? That is exactly what happened. First, refiners were locked up. They stopped taking metal from suppliers. Then coin shops couldn't get new coins from refiners, so they stopped buying and selling. After that, wholesalers ran out of money. The whole silver supply chain came to a halt. Not because demand went away, but because the market's financial infrastructure couldn't keep up with the speed of the price change. The business fell apart for a short time. For $121. Now think about what happens when you reach $200 or $250 or $300. The same infrastructure that broke at $121 doesn't get stronger, it gets weaker. Everyone in the business learned that the system can't keep up when silver really runs. Now, let me talk about the crash directly, since I know a lot of you saw silver go from $121 to $64. That is a 47% loss. Some technical analysts said right away that it was a final blow off top. They said that silver was done for decades. I've seen the posts all over the place. I took a close look at the analysis, and here's what I really think. Silver went up by 140% in 2025. In January alone, it added another 70%. In just 1 month, 70%. I don't care if it's gold, silver, Tesla, Nvidia, or soybeans. If you show me a chart that went up 70% in 30 days, I can say for sure that a correction is on the way. And a change happened. One that was painful and violent, but a correction is not the same as the end of a bull market. This is what really makes me think this bull market isn't over. The stocks in mining. The stocks of silver mining companies only went down about half as much as the metal itself during the crash. In a real blow-off top, the miners are completely wiped out. They lead strongly to the downside. This time, that didn't happen. The miners stood their ground. And in past bull markets, like from 2003 to 2006, 2009 to 2011, or 2020 onward, one of the most reliable signs that the move still has life is miners holding firm while the metal corrects. We're in a time of change, not the end, and the basic picture backs that up completely. Silver is still in a global supply deficit for the 5th year in a row. Demand is outpacing supply, and there is no end in sight. And the demand is coming from both sides at the same time. Solar, electric vehicles, semiconductors, and defense are all pulling metal out of the market. People and institutions that are looking at the same macro data I showed you and deciding they need hard assets that aren't in the traditional financial system are driving up demand for investment. That two-way demand is what sets silver apart from gold. Gold is mostly used as money. Gold goes up when people lose faith in the financial system. But silver gets hit from both sides at the same time. Investment demand takes metal off the market. At the same time, industrial demand takes metal out of the market. Supply can't keep up with either one on its own, let alone both of them together. And now you're adding government stockpiling to all of that. 3 different sources of demand are fighting for one limited supply. The big banks know this very well. There are reliable reports that JP Morgan has changed its position on silver to net long. they've moved their metals desk to Singapore. They are paying for the new critical mineral smelting plant that the Department of Defense has ordered. The COT data shows that the 5 biggest banks in the U.S. have all gone net long in futures contracts. The full picture is more complicated. The commercials are still net short about 81,000 contracts compared to 35,000 long on the latest HOT report. And the over-the-counter derivatives positions are still hidden, but there is no doubt about the direction of change. The banks are changing where they are. In this market, there's a saying that sticks with me all the time. 10% of the time, 90% of the move happens. If this gold bull market started in 2000 at $252 an ounce, then it has been going on for 26 years. 2.5 years is 10% of 26 years. About 6 months ago, silver broke out. That means there are about 2 years left. And if history is any guide, that's when the acceleration phase starts. The phase of growth, the time when silver doesn't go up by 10 or 20%. It moves in groups, and this is what connects all the pieces. The choice to bet $20,000 on gold and stockpile silver. Those 11,000 contracts are betting that gold will go up to $15,000 or $20,000. If that happens, silver won't stay at $77. During the last phase of a precious metals bull market, the gold-to-silver ratio has historically dropped sharply. If the ratio goes back to its historical mean of 40 to 50 and gold triples, silver could go to $300, $400, or even higher, and you can buy it for $77 right now. That's 37% less than its highest point ever, when there is a structural lack of supply, with the U.S. government getting ready to start stockpiling it, with China actively limiting exports. Then put this on top. As of February 1, 2026, large companies' 401k plans and defined benefit plans can legally offer gold and silver as investment choices. You don't have to do it, but you can. And as workers see gold getting close to $5,000 and silver sitting at $77, and they read news stories about important minerals and the government stockpiling them, some of them are going to allocate. Not all of them, but not all of them. And in a market as small as silver, even a small amount of 401k money coming in puts a lot of pressure on demand. Wall Street is actively working on a new portfolio model. 20% of the money is in bonds, 20% in gold, and 60% in stocks. That's a huge change from the usual 60 to 40 framework. And if 20% of institutional money moves into gold, the extra money will have to go into silver. It always has been. Every time gold goes up, silver goes up too, and silver always goes up more than gold. And there's a geopolitical wild card that no one is taking into account in their models. Iran. Trump has told protesters in Iran that help is on the way. The Ayatollahs aren't talking about how to enrich uranium. They're not talking about ballistic missiles. They're not talking about how to pay for proxy forces in the whole region. If there is a big war in the Middle East between the U.S. and Iran, gold will go up right away and silver will follow right behind it. There might be a quick drop first, like what happened in 2008, and then a straight shot back up. But when there is a big geopolitical crisis, people always turn to precious metals first. And silver, in particular, becomes a safe haven play on top of its already strong story about industrial demand. War doesn't make people need solar panels or semiconductors any less. It makes the military spend more money, which makes people use a lot more silver. So, even if things go really bad in the world, silver demand doesn't go down. It speeds up. Here's something else that the mainstream financial media won't tell you. The fight between silver's physical and paper markets is far from over. The physical market took over price discovery for a few months in late 2025 and early 2026 on the Shanghai Metals Exchange. Chinese buyers were setting prices based on how much metal they really needed. Industrial users really needed the metal in its physical form. Asian retail and institutional buyers were buying more and more investments. The paper market, the futures, the options, and the layers of leverage on top of more leverage lost control of price for a short time. Then the crash happened. That short-term fight was won by the paper paradigm. By the end of the month, banks that were short 50 million ounces of silver at $121 were able to push the price back down to $78. which made their books look good for reporting. It wasn't a coincidence that both major corrections happened right at the end of December and January when banks need to mark their positions. But winning a battle doesn't mean you win the war. The physical demand is still there. There is still a shortage of supplies. The Shanghai stockpile is 11 million ounces. China is actively limiting exports. The government of the United States is going to buy something in the market. And every time the price goes down, new buyers come in and buy up the selling. The real world will take over again. It will happen soon. I want to be very clear about what I think is going on here. I think the people who made the $20,000 gold bet know everything there is to know about yield curve control. They know that there is no way for the U.S. government to pay back $40 trillion in debt at normal market interest rates. They know that the only choice left is financial repression, which means negative real rates and a controlled drop in the value of the currency over a long period of time. And they're getting ready for the end of that policy to happen. I think that the silver critical mineral designation means that the U.S. government is openly saying that silver is a strategic resource they can't afford to lose access to. Not just because of solar panels and electric cars, but also because China controls 70% of the refined supply and is actively limiting exports. Silver is now a direct threat to national security. And money goes to national security issues. That's it. No arguing over the budget, no political deadlock, they get money. I don't think the bull market ended with the crash on January 30th. It was the shakeout, the forced sale of positions that are too leveraged. The margin calls are taking out weak hands. The same thing happened with gold in 2008. During the financial crisis, gold lost 30% of its value. Then it climbed from $700 to $1,900 over the following 3 years. The crash was the setup for what came next, not the conclusion of the story. And I believe silver at $77 during a structural supply deficit, with government stockpiling imminent, with Chinese export restrictions tightening is one of the most mispriced assets anywhere in global markets right now. I want to leave you with one thought I haven't heard anyone else on YouTube articulate. Every study ever conducted on fiat currencies that are unbacked by a hard asset has reached the exact same conclusion. They all eventually get debased to zero. Every single one throughout history. The US dollar is not exempt from that historical pattern. I don't really think we're going to zero, though. I think they'll try to put in place a new money system before things get that bad. But the way to go is very clear. For gold and silver, the direction is all that matters. We're seeing the start of a big price change, not the end of one. The $20,000 gold calls don't say exactly what the price will be. They're guessing which way it will go, and the way things are going is a lot better. The choice to stockpile silver isn't based on just one government order. It's about a change in demand that will last forever. The U.S. government is a new buyer in the market that wasn't there before. When it needs something, it is the biggest buyer in the world. This is just my opinion and not financial advice in any way. Do a lot of research on your own. Make your own choices based on what you know. But the information is still the same. There are 11,000 contracts that bet on gold worth $20,000, designating minerals as critical, funding for stockpiles of $2 billion. China controls 70% of the supply and limits exports. There are 11 million ounces of inventory in Shanghai. Silver on COMEX was less than 100 million, higher lease rates. Mining stocks are holding steady. The gap in supply is getting bigger. Yield curve control is now official. There is something important that Wall Street knows. The government of the United States knows something important. And now you know it too. Leave a comment right now and let me know if you're ready for what's coming. Gold? What about silver? Miners? All of them? I'll pin the best answers so everyone can see them. Send this video to someone who owns precious metals. Most people have no idea that the government just listed silver as a critical mineral. Not many people know that there are $20,000 gold bets being placed right now. Please help me change that. Hit that button right now if you haven't already. I'm putting together the pieces that no one else on YouTube is putting together. The memo from Bloomberg, the deal with Russia, the crackdown in China, the data on corruption. And now the $20,000 calls and the announcement of the silver stockpile. Every day I break down what's really going on with hard data, reliable sources, and analysis that you won't find anywhere else. Stay sharp, keep stacking, and I'll see you soon.